Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Are you ready for some straight talk on retirement planning without all the fluff? Well, you found the right podcast. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. This episode's going to be a little bit different than you're probably used to. And of course, everybody knows 2024, this is a big election year. And with that, we've had a lot of review meetings with clients that are both local here to the St. Louis, Missouri, Illinois area, and then also clients across, I think, 24 or 25 different states that we work with virtually. And many of them have been asking about the election and what that might mean for the stock market and the economy moving forward. But today's discussion is not going to be political, meaning it's not Trump versus Biden or Biden versus Trump. We're not going to get into that stuff, but rather it'll be sort of like a look back at not only election years, but also the party in the White House versus the party that controls Congress. So this episode should be a lot of fun, and I will promise and restate that this will not be a political discussion today. There are a ton of other podcasts, there's news outlets that you can enjoy and get into all that fun stuff. Believe me, if I say anything political or even slightly political, I get emails and messages and things like that, so I'm going to avoid that. But today's discussion will be insightful and enlightening, and you'll probably learn a thing or two that you didn't know already. And before we get into today's podcast topic, I wanted to mention our website, which is a resource for everybody. You can go to retirementmadeeasypodcast.com. While you're there, you can click on resources. You can download free resources, Blueprint to a Dream Retirement. We have a retirement budgeting tool that a lot of people have been asking for. We also have 2024 Market Outlook, which is available. And last but not least, my secret sauce to retirement. So again, retirementmadeeasypodcast.com. And I've had a couple of people ask, how do we work with you? How do we talk to you? Is a link at the top that says work with Greg. You can kind of read what that entails. And there's a form that you can fill out at the bottom. So check the website out, retirementmadeeasypodcast.com. All right, let's talk election years, election cycles, what that does for the stock market. Once you hear this, you can impress all your friends. And I will include a couple links to the articles that I'm going to be referencing in today's discussion. One of them is Presidents and Their Impact on the Stock Market. That's through Investopedia. Author is Caleb Silver. And the next article is How Presidential Elections Affect the Stock Market. It's dated March 13th of 2024. And that was actually published from US Bank Wealth Management. Their analyst did a very good job on that article. So generally speaking, and this is looking back at a 2021 Dimensional Funds report, generally speaking, the market behaves very well in election years. Looking back since 1928 at every election year, and there have been 24 election years since 1928, 20 of the 24 were actually positive. That's 83% of the time an election year, the market is positive. That's very good. The bad news is the market tends to be more volatile in election years because there's a lot of headlines, there's a lot of uncertainty, a lot of news, right? And very short term, the market can be up and down and experience a lot of volatility due to these headlines. It's kind of like the attitude of a teenager. It can be up and down and moody and happy and all over the board. So there's a lot of evidence that supports that, hey, election years tend to be more volatile or choppy than a normal year, a non-election year. So the bad news is election years, typically, if history is any guide, and I will argue it's the only guide that we have, they tend to be more of a roller coaster ride of emotions. And the market tends to dip and dive, so to speak. Now, before we get into presidential cycles and how the market tends to behave one way or the other, I want you to understand the market in general, kind of holistically, is a market of stocks. And the market long-term will always follow earnings of those companies. And what I mean by that is if it's a market of stocks, the stock market is a market of stocks, different publicly traded companies. And as their earnings, current earnings and future earnings look and perform, well, typically the share price of the publicly traded company will follow. The worse the earnings, well, the share prices tend to go down. They tend to follow the earnings of that company. And when the economy is rocking and companies, their profits are hitting records and their sales are up and revenues are up and they're expanding and things are good, well, typically the share prices will follow. On the flip side, as the economy is shrinking and you fall into a recession and companies are laying people off to cut their costs because their revenues are down, their sales are down, their earnings are down. That's bad news for the stock market, and typically the price of the shares of stock will go down. So in this article, which again is in the links, How Presidential Elections Affect the Stock Market, it also included in scenarios of rising economic growth, meaning the country is expanding, versus falling growth, meaning it's shrinking, it's decreasing, and rising inflation versus falling inflation, and then a combination of the two. Well, basically what this study shows, the S&P 500 does very, very poorly in periods of falling growth, decline, and high inflation. No surprise there. And the market does the very, very best when the economy experiences rising growth and falling inflation. And what this article did is it looked at, scenarios of the S&P 500, that's 80% of the US stock market. When does it behave the best, typically, historically? And they looked at 3-month average periods, 3-month average rolling periods. And whenever you have rising growth, well, that did second best. But when you have rising growth with falling inflation, when they're hand in hand, that does the absolute best. And on the flip side, the S&P 500 growth, it's always the worst when you've got declining growth or falling into a recession plus rising inflation. That's like the worst case scenario for the stock market. And this whole thing, this whole push with the Fed raising interest rates in an effort to get inflation down. Well, these high interest rates are bad for the economy as a whole. They really weaken the economy. But then the hope is, once inflation is down, we can start dropping interest rates, which will be good for the economy and good for the stock market. So that's kind of where we're at right now. Now I want to switch gears and start talking about historically the presidential cycles and what is best and worst for the stock market. So first of all, what I want everybody to understand, and there's a lot of studies that have measured this, there's not enough evidence to support the idea that, the stock market does better under a Democratic president or the stock market does better under a Republican president. There just isn't enough evidence to support either idea. However, we can look at the party that's in the White House and the party that controls Congress, and we can come up with better determinations of when the stock market does better. And so that's just taking it a step farther. So this study, and this is in the show notes, they looked at the S&P 500 since 1948. So that's one downfall. I mean, we don't even have 100 years to look at. And they're looking back to 1948 and they're using the S&P 500 in this study. Well, the S&P 500 didn't begin until 1957. So it was the S&P 90 before then, and that was introduced in 1928. So that's what they did in this study is they looked, we'll go back as far as we can on the S&P 500 until 1957, and then we'll use the data from the S&P 90 going back, 9 more years or so. All right, so let's look at the results. Let's look at the worst scenario first. When you have a Republican in the White House, but you have Democrats that control Congress, you've got the worst case scenario for the stock market since 1948. Those results tend to be well below average. The best case scenario, stating back to 1948, is when that you have a Democrat in the White House and you have a split Congress, which is the House and Senate control. And that is only slightly better than the results of the market when you have a Democrat in the White House and you have Republicans controlling Congress. That's second best. And it's only less than 0.1% difference between the two. And last but not least, when you look at scenarios where one party has control of both the White House and control of Congress, the results are not statistically significant. What that means is you can't come to a meaningful conclusion. The relationship just isn't there. One doesn't drive the other in any meaningful way. So if one party hypothetically had a sweep, meaning they get control of the Congress and control of the White House, there's just not enough data to go back on that says, hey, that's going to have a meaningful impact on the stock market one way or the other. So I hope this discussion has been insightful or interesting nonetheless. It's kind of fun to think about and talk about. Everybody has their opinions, and everybody likes to either give credit to the president based on the stock market performance or be critical of the president due to stock market performance. Now, keep in mind, there's things that are going to be completely, like stock market performance, completely out of who's in the White House and whether it's Donald Trump or Joe Biden. Some things are going to be totally out of their control. And here's a perfect example. When George W. Bush was elected president, 9 months later, we had a horrific terrorist attack, 9/11, and the stock market absolutely collapsed. And that is the definition of victim of circumstance. That terrorist attack was totally out of his control. Now, with that being said, if you're interested, that first article will actually go back and look at how the stock market performed during each president's term in office, dating back to Eisenhower, his first term. And you can see so far through January 31st of this year, during Biden's term, the market is up 30.5%. When Trump was in office during his term, the market was up 69.6%. It did pretty well. Obama, his second term, it was up 52.9%. And during Obama's first term, it was up 84.5%. And during both of George W. Bush's terms, the market was down 12.5% the first term and 31.5% the second term. During Clinton's years, they were up in the 70% both terms. During Bush Sr.'s first term, or only term rather, 51.2%. And then prior to that, Reagan had two terms, 30.1% and 67.3%. But again, as we showed and we talked about earlier, we cannot scientifically measure a president's impact on the stock market performance based on their party affiliation or their policies. It's absolutely impossible to do. And I wanted to end on this note. I've been a financial planner, retirement planner for about 15 years. And I have worked with clients throughout those years. And every time there is a presidential election, without fail, there's always one or two clients that let their emotions get in the driver's seat, so to speak, when it comes to their investments. And they make unwise decisions with their investments. Typically, that means that they're selling long-term investments to move to something more safe in nature, whether that's a CD or a money market or something like that, because in their mind, the market is going to crash with this new president, whoever it is. And every time this has happened, and again, we're talking every presidential election, this is one or two clients. So this is not happening all the time. But in every instance that this occurred, the client wished they would have just stuck with the long-term investments, the long-term portfolio that we had positioned. And it ended up costing them in each scenario missed opportunities for market growth and portfolio performance. And what that amounts to is thousands and thousands and thousands of dollars of growth in their pockets because they tried to speculate on what was going to happen to the market. And in every single situation, and I can look back every single election, it happens one or two times, it never worked out for the client. So as a financial planner, we are our clients' financial advocates. We can strenuously suggest and we can make recommendations that we believe are in somebody's best interest. But again, the client has all control. And if they decide, hey, I want to make this decision with my investments because of the election. I want to do whatever it is, and that might be abandoning their long-term plan. Well, legally, we have to listen to that and follow their instructions. And a friend of mine is an advisor through one of the big firms, and he's been at a couple. And so he is basically on a call center. He's been at Fidelity and Charles Schwab, and he is in charge of thousands and thousands and thousands of what he calls accounts. And so with this, the clients that have accounts with these firms call in and they give instructions to the advisor answering the phone. He said over the years, it's the same thing. When elections come around, people let these emotions get in the driver's seat. It's the same thing I'm experiencing with a little over 100 families that we work with. He is dealing with thousands and thousands and thousands of people that have accounts with their financial institution that he's in charge of. And he basically just takes instruction from those people. And he said there are so many people that want to cash out their investments because of an election and a fear that the market's going to crash. He said it happens every single election cycle. October, November, the calls just go way, way up and people start selling out of the market. And this is just another example of why I strenuously suggest working with a fiduciary financial planner, because there's a ton of studies out there that show that people are very, very poor at managing their own investments because they don't stick with investments, or they want to switch from this to that. They sell at the wrong time. They let these headlines get in their head, and then they make poor decisions, like election cycles is another example. And what ends up happening is their investment results really, really suffer because of these short-term decisions that they make, and it really, really costs them. So I would encourage you, stick with your long-term plan. Whatever that portfolio that you have developed with your financial planner, stick with it. Just because there's an election coming in November, that should not dictate any decisions that you make, because short-term decisions can have long-term consequences. And diving in and out of the market because an election is imminent, well, that's just another example. So I hope this episode of the Retirement Made Easy podcast has been helpful. If you have questions, visit my website, retirementmadeeasypodcast.com. You can submit your questions there and get a hold of me. I'll see you next time. And remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, tax advisor, or financial advisor prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. The SmartVestor program is a directory of investment professionals. Neither Dave Ramsey nor SmartVestor are affiliates of St. Louis Retirement Advisors or LPL Financial. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.